Sawadee Krap, that's hello in Thai. My name is Anthony and welcome to Quantum Finance. Lately, I've been reading and hearing a lot of articles and videos on inflation. Are we heading into a hyperinflation? Contrary to what the media or other YouTubers are saying that we're heading into a hyperinflation crisis, I personally do not think so. In this video, I will present you the data and facts to support my thesis on why we will not head into a hyperinflation crisis. I will also give you my top 3 reasons to this. All I ask for in return is that you help us grow this channel by liking and sharing the video. If you have not already done so, please subscribe. Please help us reach the 10K sub. We're almost there at 9.9K. Also, hit the alert bell button so that you get my latest video update. If you want to get 2 free stocks, value up to $1,850, all you have to do is sign up with Weibo, open an account, and deposit $100 into your account. They're now giving out Tesla as well as Google and other stocks. Yes, our viewers have received Google, Facebook, and Apple stocks. Please note that this video is for pure entertainment and education only. I'm not a licensed financial advisor, but that does not mean that I will give you data, facts, and other ideas to supercharge your portfolio. With that out of the way, let's get right into it. What is inflation? It is the decline of purchasing power of a given currency over time. Here's an example of inflation. Take a look at this picture depicting the price of a cup of coffee. In 1970, it cost you about a quarter to buy a cup of regular coffee. As you can see through time, it increases to about $1.59 by 2019. This erosion of the purchasing power of the dollar is what we call inflation. Economists measure the inflation by the annual change in Consumer Price Index, or the CPI. This is a basket of household goods and services that we purchase. Here's a graph showing the inflation throughout the years from 1914 to 2021. As you can see, in 1920, it peaked at 23.38%, and the highest peak next to that was in 1980 at 13.55%. From 1992 onward, the inflation rate was below 4%, which is considered moderate inflation. Anything over 4.9% is considered hyperinflation. Anything between 3.3 to 4.9% is considered high, and anything less than 2.3% is considered low. The latest inflation data as of February 2021 is only 1.7%. It is presumably to have gone up to 1.8% or so by March 2021. Let's show you another graph. Since 1989, inflation rate has been decreasing from its peak at 6.29% down all the way to 1.7%. Here's another chart showing inflation rate from 2000 to 2021. Note that the inflation rate is within the pendant triangle pattern. Fed Chairman Powell has stated that inflation is predicted to reach above the 2% level. Here's another chart zooming in from 2010 to 2021. Do note that it is normal to see inflation rate to fluctuate up and down. The reason I'm showing you all these charts is to demonstrate that in the big picture of things, inflation rate is relatively falling over time. So with inflation rate going above the 2% level, this is still relatively low from the big macro picture standpoint of view. So what is all the fuss about? Well, for one, inflation will erode the purchasing power of the dollar and create uncertainty as businesses will have more difficulty estimating future costs. And 2, inflation rate usually correspond to high interest rates as lenders need to compensate for the decline in purchasing power of future interest and principal repayments. The net result is a high cost of doing business and could potentially slow down the economy. Let's look at the 10-year Treasury rate chart. As you can see, the rate has been on the decline since the 1980s. If we zoom in on the past 5-year chart, it is the rate of change in a relatively short period of time on the interest rate that spooked the market because everyone was expecting it to stay near zero as stated by Fed Chairman Powell. I guess when the rate is so low, near zero, there's no other place that it can go but up. Okay, so what caused inflation and why do I think that we will not be in hyperinflation? 1, increase of money supply. Let's take a look at this. In 2020, the government printed tons of money to stimulate the economy from collapsing. As a result, about 20% of all US dollars' existence was recently printed in the past 12 months. Yes, in the past 12 months. In theory, economists states that within some increase of massive volume of dollars printed, we will have too many dollars chasing the same goods and services, which will lead to a hyperinflation. The problem with this theory is partially true. What we saw during the pandemic was that people and businesses started to cut their expenses and save more money in preparation for a rainy day. So when the government sent out stimulus checks to US citizens, a good percentage of US citizens were not spending it but investing in stocks and other areas. The same is true with businesses. But the majority of the money printed actually went to banks and they're hoarding it. They are not spending the money, nor are they lending them out as loans. This in turn decreased the circulation of the money into the economy. So it is interesting to note that as the government printed more money, most of those money are being hoarded by the banks, businesses, and people, and therefore creating the cycle where there is less money in the circulation. Thus, printing more money did not create the hyperinflation as anticipated. In a matter of fact, you can see from this chart, since the quantitative easing or QE program was put in place in the late 2008 to 2009 due to the financial crisis, the government have been pumping more money into the system. It is the top 1% of the wealthy, banks, and businesses that are hoarding the money, and therefore we have actually seen inflation in decline. Now, the Fed is taking an aggressive approach to QE program, and we're in a new territory where we have no reference of it will work and what's the after effect, since we have never seen this before and we have never experienced this before. 2, the anticipation of the global economic reopening that will create economic growth. This is where economists expect that there will be an increase in demand of goods and services that will exceed the production capacity. This is because of the pent-up demands for travels, for cars, etc. However, as we know, technology is a deflationary because it improves efficiency in productivity and therefore requires less human labors. For instance, during the pandemic, we have seen an acceleration of technology and innovation that improves how we work and at the same time eliminate lots of jobs. Zoom, for instance, has created a new work model where you can work from anywhere remotely, saving companies lots of money from rent, utilities, transportation, etc. There are certain companies that are actually discovering that their employees are more productive working remotely and is actually saving lots of money from building new buildings to house them, to support them, etc. And if you work at Facebook or Google, they don't have to service you with food anymore, no free food, because you're working at home. The cause and effect of this is that it will decrease the need to buy cars, and if there's less cars on the road, there will be less demand for fuel, less maintenance on the car, etc. So you see where I'm going with this. Then there's the automation where it will eliminate certain jobs while creating new jobs. For instance, in the near future, Tesla autonomous vehicle technology will eventually eliminate Uber and taxi drivers. Technology has a history to disrupt the economy by displacing low-skilled workers. The pandemic only accelerated it. For instance, the pandemic has caused retail companies to shift to e-commerce, eliminating cashiers, salespeople, etc. The point behind this is that we will come out of the pandemic with a new economy thanks to the acceleration of technology and innovation. In summary, technology and innovation will reduce the buying power of the masses. Long term, this will reduce the inflation. 3. Supply chain issue caused during the pandemic could potentially increase the production costs and or decrease in supply of goods and services. As we have seen, the pandemic has created a global shortage of microchips in auto manufacturers. At the same time, technology has reduced the cost for raw materials or components such as EV batteries, and automation has helped reduce the cost to produce the EVs. Thus, companies are able to produce goods at lower cost than ever before. Take Tesla, for instance. They're able to produce and sell their EVs at a lower cost than ever before. With rising demands, companies are also increasing supplies to meet those demands. As in the case of the microchip shortages, this is a short-term pain. Yes, we will feel a lot of pain, but long-term, they will be a blip in the history as chip manufacturers rush to increase their manufacturing capacity. Therefore, technology is a deflationary, and thus the chance of hyperinflation is being countered by technology. Technology allows businesses to achieve more with less. In conclusion, we'll see inflation rate above the 2 to 3% as predicted by Fed Chairman Powell. But hyperinflation? No. Based on the historical data and the facts that I provided, I think it is highly unlikely. Because most of the money are being controlled in the hands of the top 1%, the banks, and the fact that technology is creating deflationary, there is a low probability that we'll see a hyperinflation rate at 4.9% or above. Also, the fact that I do not think the US government nor the Fed will allow this to happen. Let me know what you think, if I'm wrong or right on this thesis. Love to hear from you in the comment section below. I'll see you down there. So there you have it. If you like these type of technical analysis along with stock picks with suggested entry and exit point, be sure to check out our patrons by clicking on the link in the description below or in my comment section. Wish everyone much success, and let's go make lots of simulars!